Welcome to Your Hometown Solutions. I'm your host, Jean Newell with Waterview Realty, and we meet our experts here in the studio, and we talk about all kinds of things that concern you, your family, your finance, your home, your garage, your garden, just about anything you can think of. We'll talk about it here, and we're very pleased to have one of our experts in the studios, who is Coleen Quick. But before she comes on the mic, it's National Women's Month, and we thought that was kind of appropriate because I'm constantly asked, how far have we come in the business world? Because I can remember many years ago when I first got into real estate, when we wanted to, when we were working with a couple and we needed to use both their incomes to qualify them for a loan, if the woman was within quote-unquote childbearing years, we could not use her income. So that was only a few decades ago, and women could not get credit cards in their own name. It was pretty hard. You couldn't really buy a house in your own name. It was not impossible, but it was always your husband had to sign or your father had to sign for your credit cards. So keeping that in mind, we're asking the question, are women still earning less than men? What are the financial challenges facing today's woman? In the studio with me today is Coleen Quick, a financial advisor with Edward Jones, and we're going to put the spotlight on these and other concerns for today's woman. So thank you, Coleen Quick, for coming out to the studios today, and we're going to just pull back the curtain and we're just going to tell it like it is. Thank you, Coleen. Welcome.
Thank you. Thank you for having me.
So, Coleen, tell us a little bit about you, your credentials, and so forth. What actually makes a financial planner? Do you have to go to special school? Do you have to get a special license? Exactly what is your background?
My background is that I attended Hope College in Holland, Michigan, and I studied international business and Spanish. As far as becoming a financial advisor, there's not a particular major that you must choose. However, the finance classes did help when I was studying for the Series 7, the Series 6, and also the Florida 215 Health and Life. So not necessary to have a certain major, however, was definitely beneficial while studying.
So those
for
were licensed.
Exams.
Those are specific
Yes.
license. What were they again, and what
The
do they
Series
cover?
7 and then the Series 66. Those cover a variety of things between investments, the different laws and regulations, and then the Florida 215 that covers insurance, annuities, all of it.
That, right?
All
right.
of it. Mm-hmm.
And so many times people get all their information from one of the gurus on TV, and it's hard to give out financial information in a quick little question on air on a TV show because you want to really look at the whole picture. And
Absolutely.
you need to get into people's personal financial goals and what they're accomplishing now, what they plan to, what their future looks like. And that takes a nice confidential appointment. So how did you decide to go with Edward Jones? Because that's a big name in the financial industry.
It is. I actually grew up around it. My dad is a financial advisor in Taylorville, Illinois. I'm sure you've never heard of the town.
No, but where is that in Illinois?
It is about 45 minutes outside of Springfield, and
Okay.
it's a small farming, rural community. Mm-hmm. There wasn't cell phone reception until about 3 years ago.
Oh my.
And he built his business essentially on farmers and business owners and the local people in that town. And so I watched him, not whenever he started 40 years ago, but just over the years, build relationships with his clients, with the community, and it was really attracted to me and able to see how he not only built into what was originally the parents, but then their kids and then their grandkids. And being a farming town, every Monday morning he has fresh eggs delivered to his office and different produce. So just seeing the relationships that he's been able to establish. So that was the original draw. And then so I have some other family members. My fiance actually does the same thing as well.
Wow.
So
Well, we know you know how to balance your checkbook for sure. But before we get in, grab a pencil and paper and jot down some of these notes, because I know you're going to want to get a hold of Coleen. Where are you located in Melbourne area?
I am located on 5410 Murrell Road.
Okay. Isn't that going to be your new office?
Yes, that is my new office. I'm actually moving in tomorrow.
Oh, okay. Great. Well, that and how about a website or a email?
My email is Coleen, spelled COLLEEN .quick @edwardjones.com. And then you can find out more information at www.edwardjones.com.
So if you can't call Coleen, call her quick. No, call.
My name's changing soon. I'm getting married, so.
Oh, goodness. Let's go ahead and let's get into that women's issue. What are the financial challenges that are facing women today?
Well, for one, women are living longer than men. A 65-year-old woman is expected to live on average another 20.5 years compared to men only living close to 18 years. And that's once they're age 65. And so that's another 2.5 years that women are living longer than men.
And a lot of women don't realize that when their husband passes away, there goes that Social Security check too. That they can apply for their widows, but it never is the same as having two Social Security checks coming in. So that's a problem, isn't it?
Right, and it always depends on each individual with what their Social Security was prior. Mm-hmm. So everyone
is different. Right.
Mm-hmm.
That's another reason why you have to sit down and confidentially look at the whole picture. So what are some of the things that you're seeing with the women coming into your office? What are their biggest concerns besides living longer than their husbands?
A lot of women are concerned about just not knowing the type of investments that they're invested in, and also just being unaware. A lot of times I hear women say, my husband takes care of everything.
Oh, yes.
It's fine. He knows it all. It's like, well, what would happen if
Yes.
something happens to him? It's so important that, not that they need to know every little detail down to the last penny and dime, but it's so important to know where your finances are going and why.
Exactly. And I think a lot of people don't really know what all these different things mean. Let's go into just a little definition on stocks, mutual funds, IRAs, Roth IRAs, futures, a versatile portfolio. Boy, we can't say all that in about 30 seconds, but the difference between a stock, a mutual fund, and especially the IRAs, people get that confused, the Roth IRAs and the other. I mean, I know just about enough to fill a shot glass. And sometimes you feel like having that shot glass after you full when you go over these. But these are the things we need to know. We really need to educate ourselves, because especially about 10 years ago when everything went haywire and all the monies, I mean, I lost a lot of money, and various other people that I know did as well, because, and I don't know if there was anything we could have done about it, but the fact that we were maybe not diversified enough or didn't understand what was happening, we just sat and watched our financial portfolio decrease every month. So kind of give us a little overview of what's the difference between a stock and a bond and a IRA and so forth.
Well, to start, a bond is also known as fixed income security, and it's a debt instrument created for the purpose of raising capital. Owning bonds helps to diversify a portfolio, as the bond market doesn't rise or fall along the stock market. So essentially, it's less risky than a stock.
So is that when people say you can buy a bond, a city bond, when the cities also
so essentially,
sell bonds?
We like to think of an own versus a loan. And with a bond, so say this Brevard County School District, they issue a bond.
Okay.
And you go to purchase that bond, and they say, Jean, I need $1,000. I'll give you your $1,000 back, and then I'll also pay you interest on it. Let's say in 5 years, I'll give you 2%, once the 5 years is over with, I'll give you your principal, the $1,000, And then along the way, depending if it's a bond that pays semi-annually or monthly, there's different types, they're paying you interest as well. But you are the one that's in control because you're loaning your money to the institution.
So you actually have a certificate. So years ago, that was popular, the U.S. savings bonds or the war bonds, and people would buy them at, say, $20, and then they matured 10 or 15 years later for $25 or something like that. So that they still work the same way with the bonds today.
Essentially, you're giving them money, you're loaning them money. And the stock, so the loaning side is the bond, and then the stock is the owning portion.
Okay.
And that's also known as an equity. And corporations raise capital by issuing stocks and entitling the stockholders, or also known as shareholders, to partial ownership of the corporation.
So this is where it gets confusing to me. I hear this all the time because a lot of people that work for the high-tech companies and so forth, they collect a lot of their income through stocks or instead of just straight income. And then their stock splits. And then all of a sudden they're rich beyond belief. I've never quite understood that. So they have 100 shares of stock, and what happens when a stock splits, or how does that maneuver into the splitting? What has to happen with the business where the stock splits?
Well, essentially what's important to realize with the price of stock, anytime you're doing research on a particular company, is to do background to make sure that it's fairly valued. Because essentially the price of it is a number it's given, and there's a lot of formulas and calculations that go into defining what a particular stock should be trading at. And so what's important to realize is if it's at a fair price or if it's undervalued. There are still companies today that are undervalued. There's companies that are overvalued. And stock splits a lot of times happen to prevent the price from rising and rising and rising. Also, that will happen when there's a company that's either going to be merging or potentially there's a spinoff. There's a lot of different reasons. But what's important to just take home, I guess, is making sure that the stock price is fairly valued.
So that's some of the things that you would help people with, because you can research that and you'll be able to tell them exactly what they're looking at. It's not just buying something. You have to know what you're buying, what you're getting into, because there's some things that are perfect for one family or one person,
right? But
it would be something maybe an older person wouldn't be interested in it because maybe it's a quick growth or something that's not in their portfolio. We need to probably talk about that as well. So what do you think I know we talked a little bit about the statistics, but the statistics, I almost spit that out. The women's pay versus men, are we still at about 78% on the dollar? Do you know those facts? I know we're still undervalued.
It's according to the Census Bureau data, women working full time in the United States are typically paid 80% of what men earn.
So we've gone up a little bit, but still it's so bad. So now we talked a little bit about bonds. Now the stocks, when they see the stock market report and they give the average what's going on, and that's a Dow Jones average. They just pick 50 stocks to look at as far as their percentages, and that's how they get the figures for that day.
The S&P 500 is the one that's most commonly looked at, and it represents the 500 companies that they're using in different categories to see how the market is doing. Mm-hmm. And there are different sectors. We have energy, industrials, technology. We have consumer discretionaries, materials, healthcare, communications, consumer staples, and utilities. And what we typically do is whenever we first meet someone, we go over what their risk tolerance is, because that is one of the most crucial things.
Explain what risk tolerance is. That means they don't want to be white knuckling every day at the table with, oh my gosh, it's gone up, it's gone down.
Right. Because, people, I like my 8 hours of sleep each night and being able to sleep comfortably. And so we never want people to be in something that they're not comfortable with, and that they know the risk ahead of time. Mm-hmm. As we mentioned earlier, no one can predict what's going to happen with the market and when, but at least knowing that at some point there's going to be ups, there's going to be downs, and how your particular individual portfolio is positioned to handle it.
Well, we talked a little bit about stocks. What about mutual funds? Exactly explain that to our listening audience, what a mutual fund is.
Yes, so actually back at my office, I keep a bundle of colored pencils. And on each colored pencil, we'll say the green one, it's labeled Apple. And then the orange one's Google. I have another one, Johnson & Johnson, Duke Energy, whatever it may be. And I have them all bundled together. That represents a mutual fund. It's picking different, not only stocks, but also bonds and different investment vehicles. And essentially it puts it into one bundle. So you're not bearing the risk of, say, one company were to break. So that's whenever I pull out a colored pencil and I'll break it in half. Something happens to that company. If it breaks in there, there's still other companies backing it and supporting it.
So it's not only important what companies are within that mutual funds, but who the manager is too.
Correct.
Because whoever's managing that funds, they have to make those decisions on whether to keep it or sell it and so forth. So that's probably something that you keep your eye on who the managers are and so forth. So that's another thing. The mutual funds, that gives you a little bit more diversity because what they say, never put all your eggs in one basket, right? Now, the other thing is the IRAs, the Roth IRAs, the pre-taxed IRAs. Explain a little bit about the IRA and which one you use if you need a tax write-off for upcoming tax season, or which ones you might want to consider down the road for retirement.
I like to think of IRAs pre-tax, post-tax.
Okay.
Your traditional IRA, that is pre-tax money. And so that's whenever it comes right from your paycheck a lot of times, and you haven't been taxed on it. And that is what you can use in a lot of cases. You have to ask your own CPA, but you can use that as a tax deduction because you're contributing today for your retirement later on.
Is that when they always say just before tax season? I think you have to do it, though, a couple months before. You can do a contribution to help with your taxes. And what is it up to now? Is it $5,500 per person if it's in a couple?
Yes. And then what happens then is that, so you can use that as a deduction. So that's your traditional IRA. And you can still do the 2016. You can make your contributions up until April 15th.
April 15th. Okay. So then you have the pre-tax. That's before taxes, and that's the one you can buy to take advantage of your taxes.
Yes. And then, however, whenever you reach retirement or the age you start withdrawing, that's whenever you pay taxes on it.
So the idea is if it's pre-tax and then you withdraw when you're retired, you're in a different tax bracket.
Correct. You're typically in a lower tax bracket when you retire. So that's the advantage of contributing now and not having to pay taxes on it
and then
now.
So the post tax would, now I thought I had heard somewhere that on the post tax, if you're, and is that the Roth IRA?
This is a Roth IRA, correct.
So the Roth IRA, which is post tax, you're going to pay for the tax now, but even if it goes way up in value, you still don't owe any more tax on that.
Correct.
So you're kind of hedging your bet there a little bit because then you don't have to pay taxes at all if it's doubled or tripled or quadrupled by the time you take it out.
A lot of people really try maxing out their Roth each year. So
what is the maximum they can?
It's $5,500 as well.
That. Okay. You've been listening to Coleen Quick with Edward Jones, and we're so happy to have her here because we're talking about women's issues and women's finance because this is National Women's Month. Let's talk about diverse portfolios. You hear that used a lot in various conversations. What is a diverse portfolio?
Obviously, we talked about this earlier, but essentially not putting all of your eggs in one basket.
Okay, so.
And a lot of times it's not just diversifying between stocks and bonds and mutual funds and cash and your fixed income, but also whenever we're looking at the stock portion, we diversify in that area. When we're building a CD ladder, we diversify with that using different maturities, different coupons. Diversity ranges all over the board.
Okay. Well, we've already discussed that women are making less money, and now we're living longer. So how do we get money set aside for us to live on when we're by ourselves? So we're up against the wall here. How are women affected with their 401k contributions? Is that something that we are seeing as a problem coming up?
Well, one of the problems that women face today is that they are not able typically to work as long as men are, because they often take time off for whenever a child is born. And now we have the sandwich generation who are taking care of their parents as well as their own kids growing up.
Right.
So whenever they work fewer years, that means they have less time to contribute to their 401k at work.
So they can't really, and those 401ks don't stay with you once you leave a job. They only last about a year or something, I think, after that.
Well, there's every 401k company is different. You can leave it, you can roll it. There's different options that you have. But the biggest thing is that whenever women work fewer years than men, they're not able to contribute on those years when they're not working.
What do you think some ideas would be to overcome some of these challenges?
Well, for one is to invest for growth, depending on your age and what situation you're in. But a lot of studies have shown that women may invest less aggressively than men. And if you invest mostly in conservative vehicles, you may run the risk of falling short of your financial goals. And to achieve these goals, you'll need a reasonable amount of growth potential in your portfolio.
Now, I know we can't really talk about necessarily what stocks are growing right now, but in general, what is considered a growth stock? Does that fall into a certain category, or is it like a conservative stock, or how do they rate a growth stock?
A growth stock is rated by analysts of seeing what their performance has been for the last 10 years and what they project it to be for the future as well. And then so we balance with growth stocks, and then we also have stocks that are paying dividends. And right now, especially with individuals who are retired but still want to be able to be growing with their portfolio, they use dividend-paying stocks as a vehicle that helps get them some growth, but also that constant dividend coming in.
Well, we've been talking a little bit about women working, but how do we get prepared for retirement? Because sometimes when we're retiring younger, maybe we're retiring at 65, and now we got 20-some years that we have to make sure we have money set aside. And as well as we might want to use some of that retirement money to take a vacation or a journey or one of the things on our the French Riviera, as you said, wherever. So what are some of the things that you think are good ideas as far as what you need to do to start looking at the future? I know the younger you start, the better, but if let's just pull something out of the air here. If you're a woman of 40 years old and you really don't have a good portfolio right now, of course, the first step would go sit down with a financial advisor. We know that. Sit down with a financial advisor and let's see where you're going with that. But would you have kind of an idea what you would want to put her in or a couple in to get as much growth or get some stability so it will make sense in 20 years that they'll have a little bit of a nest egg? It's not going to be as big as if they would have started at 20 years old, but it's never too late to invest, but you have to invest more as you get older.
Right. It's definitely never too late. And one of the biggest things that my dad taught me growing up was pay yourself first. So make sure that with every paycheck that you're putting some money aside for retirement.
Exactly. And you can have that come right out of your paycheck too, because then you don't miss it.
Right.
Everybody always says, yeah, well, I'll write a check to myself and I'll send it off to the financial advisor. But
the old saying, use it or lose it.
Yeah, that's exactly right. Is there kind of a magic formula that, you start off with? Maybe if you're in your 20s, you're putting away 5 or 10% of your income, and as you get older, you're putting away a little bit more? Or is there I know, again, everything's on a one-to-one basis, but how would you feel about answering that question to somebody that came in?
A magic formula. I don't think it's necessarily there's one particular formula, one size fits all. I think one of the things that I like to do with everyone who I sit down with is create a budget, because essentially you don't know where your money, I mean, we think we know where our money's going, and it's amazing how people, they sit down and do the budget worksheet. They're like, there's no way we just spent $500 at the grocery store this month.
Exactly.
Or wherever it may be, because a lot of times you can actually be contributing more to retirement than what you actually think you can.
Exactly. And sometimes I think it's easier if you start small and you don't miss it. Mm-hmm. And then every 6 months or every year, just bump it up a little bit more and a little bit. Instead of trying to say, I'm going to set aside 25% of my income every month. Well, that's probably not going to happen. But sometimes 3 or 4 or 5%, you don't even miss it.
Right.
And then you kind of ease into it. I think that would be kind of an interesting ladder, just showing maybe how people could just do 1% a year or 2% a year.
It's amazing what you can do. And that's why we're so big on, one, knowing people's risk, because everyone has completely different comforts with risk. And then also going through the budget, making sure each individual, each couple knows how much they're spending, and then having a plan as to putting X amount away each month, knowing where every dollar of that is going. And then knowing whenever you reach retirement, or even if you're already in retirement, what your money's doing and why, and that you're on track for achieving goals. It's all because, I mean, I'm a runner, and I think about the marathons I've done. And if I don't have a plan of attack and know exactly how many miles I'm doing on what day, where, when, then race day, it's just, hope it goes well. But versus whenever I am very structured and know what's happening, how many miles, all of that. I like to think of it the same way with investing and planning for retirement, or already being in retirement, just sticking with that plan, having that peace of mind of, this is what I'm doing and this is why.
There's some investments that you can borrow against and take money out as long as you put it back in within a certain specific time. And there's other investments that you don't really want to have to touch because you'll get penalized and too expensive to be penalized. Am I making sense? What kind of investments that you can actually still, I think 401ks you can borrow against, but you have to put it back in within a specific time. But there's also some different funds and stocks and so forth like that too. Is that right? Or am I making this up? Though there probably is some things. You just have to look at the whole picture. That's why it's so important to sit down and find out. If you're going to feel like you're going to need to pull money out of your financial portfolio, that's the things that Coleen needs to know. If you're going to have to maybe pull some money out because you don't want to have it tied up into a fund that does not allow any kind of contributions being paid before the mature date or at a specific time. So those are all the kind of things that are so important to know when you're getting ready to start investing if you haven't already. So if someone wants to come in and sit down with you and let them just give you let them have an overview of their financial picture. Maybe they don't have anything right now. What would you like to see them come in with? Do you need some a budget, a couple bank statements? Do you just need to have them write some things down? Do you have a kind of a checklist of things that you provide to them that they need to bring in to sit down with you so it makes it a little easier for their first meeting?
We use a systematic process for the first time we meet with somebody. And so essentially, like I mentioned earlier, we go through their risks, what their goals are, what they're spending now, what they want to spend in retirement, if they're already retired, what they're spending, and then what they're taking out each month, making sure that we know their systematic withdrawal rate. And then a lot of times, if they already have an old 401k, we'll look at how that's invested, or say they have their money at a bank and they're not sure, they invested it 20 years ago. They're like, I just kind of left it there. I haven't changed anything. What we do is I'll put it into our portfolio rebalancer, and it'll show, you are, 70% in equity right now, and you're 70 years old. We should maybe be shifting some things around so that it aligns with your risk and your stage of life.
Exactly. So that's what do you do? Have people come in on a semi-annual basis to take a look at what their situation is now, just make sure you update their
semi-annual, and then I also like to call once a quarter just to let them know how performance is doing, as well as any news that would be relevant to them. And because there's a lot of changes going on with the Department of Labor, and just keeping clients aware, because it's important to know what you own and why. And
I know one time we had I think it was a tax advisor on here. We were talking about different things, and they always say you even want to invest in some foreign things too, not to always have it all in the United States. So those are the things that we need to be looking at, especially now with a whole new government in place. We'll stay tuned on how that's going to fall through. I don't mean fall through. How that's going to follow. So you've been hearing Coleen Quick give some great advice on financial planning, and give Coleen a call or go to her website or email her, and that might be a good start for you if you're just curious about your own portfolio. Give out your information one more time, Coleen, for Edward Jones. We really appreciate you being here today.
321-638-2300 is my number, and I'm on 5410 Murrell Road. Thank you.
Thank you, Coleen, for joining me. This is Jean Newell with your Hometown Solutions, where we have experts in discussing everything from your family, financial needs, your home, your garden, your garage. Stay tuned. Next week, we have a sales director from the Fountains Assisted Living, and we're going to talk about senior care. Thank you.